Hey, welcome back to the Junius Maltby channel, everybody. Pleasure to have you here today. Wanted to go over a quick anniversary since today is October 15th and just talk about, where we've been, where we're going. It's always good to reflect a little bit on history. As the old adage goes, those who don't learn from history are doomed to repeat it. Well, October 15th marks on the calendar today, and in 2008 that was the day that the Dow fell 733 points, and it countered the huge gain that the Dow had chalked up, the biggest ever one-day point gain. On October 13th 2008 it closed over 9,000 points, and had recovered from some of the tremendous losses it had suffered, that bleak fall during the basically the incipient stage of the financial collapse when things started to just unravel and fall apart. Well, today, October 15th, would have been the day that it fell 733 points, erasing some of those gains. We all remember those tumultuous times, panic in the marketplace, people dumping and selling stocks, people fleeing into metals. A lot of questions were raised. There was a lot of things taking place during that year that we can look back on and kind of realize what we may or may not have done differently, as well as decisions that the government should have made or done differently. Now that we look at that, though, we should ask ourselves, where are we headed now? It seems like today that there's some things taking place in the political front and in the economic front. Don't mind these, by the way. These are just here to, protect these. These just protect these from your random individuals. You never know. Anyways, they make a nice backdrop, though, don't they? Anyways, here we are. It's 2013. Gold and silver have taken some dips, and they're hanging out in what some consider fire sale price categories. Right now, currently, silver is trading at levels that are agreed to be below the production costs or the mining costs of extraction and processing and everything like that. So silver being, $21? Let's check it real quick while we're talking here. I believe silver is trading right now at $21.35. That's basically 50% of its high, or even more. I mean, silver reached a high, I believe, of $48. It was just shy of 50. So, we're looking at prices that are half of and more of what it was when some people were panicking and jumping all in. Gold currently trading $1,282 an ounce. So $12.82 an ounce for gold. That's not bad. That's, for those of you that held off and stayed in the marketplace or just felt like you didn't have time to get into metals, you really should evaluate the current situation in both government and economically, as well as where you would like to be in your position with metals. It's interesting, they talk about the default right now and the fact that the government's going to, quote unquote, run out of money. And we all know the U.S. government, how do you run out of money when you have a printing press that can issue money at will? The Treasury and the Fed, in working together, can create any amount of wealth and money at the cost of the currency's strength. We all know that. There's a very good chance that if anything ever were to happen and they were to run out of money, they would just start to print it. It doesn't even take foreign nations to buy our debt, I believe. They will do whatever it takes to survive, and they will do whatever it takes to create the illusion that everything is okay. The smoke and the mirrors. And I believe that's how any country or any nation can fall prey to inflation, hyperinflation, monetary collapse. I don't see how or where it is written that the dollar and the U.S. economy is immune to the controls or what am I looking for here? Immune to the laws, I guess we could just say, the laws of economics, supply and demand. If they just crank up the presses to get us out of this mess, and they continue to purchase $83 billion a month in securities, the Fed, eventually this has to take its toll on the strength of the dollar and everything tied to it. So your pension, your stocks, your bonds, your mutual funds, all of those things are monetized in dollars, even the value of your house. So eventually, if and that's a big if, I know, we don't want to be one of those big doomsdayers, talking about the end of the world and this and that. I never have thought that it would be this apocalyptic event. It's not going to be like the road. You're not going to be pushing a shopping cart down the road with 3 feet of ash everywhere and, zombies running around. This is not going to happen. We all need to get that image out of our head as much as we can. Try to be realistic in the discussions with where things could go. We would probably see food and fuel shortages, a little bit significant changes in standard of living. There might be some social unrest in certain places. Nothing that local police or law enforcement or even groups of concerned citizens couldn't quell. But that's not the point of this conversation. The point is, where do you see things going in the future? We have an opportunity to look back. We saw how bad things got. We can read all different opinions, and that's really what it comes down to. These are all just opinions. No one knows for certain what's happening or what's going to happen. We read things like Peter Schiff, who hit it pretty accurately there in the earlier part of the decade, all the way up to the financial crisis and through it. Timing was off a little bit as far as metal prices now and where things went. The Wizards of Wall Street and the almighty Ben Bernanke, they pulled some fast ones, they pulled some strings, and things worked out. We saw it. We saw it happen. We saw, I guess you could say, a perceived recovery. We've seen some things take place and some prices stabilize and stocks come back. So a lot of people made a lot of money, and a lot of people lost money, but there's people that made money staying in stocks. That doesn't mean that those stocks are going to continue to earn those individuals money or continue to hold their value. Right now would be an excellent time to reposition yourselves in case if things were to change. The information's out there. We all read it. We all, keep track of countries like China who are buying gold, the movements that Goldman Sachs plays into the market. And then there's the questions on, is there manipulation with silver and gold? I don't. You kind of think so. Okay. You would think so by looking at how much interest rates have stayed at zero and how much money has been issued and the expansion of the money supply. It would make sense that metals would come up, and it wouldn't make sense that metals have gone down and stayed where they're at right now currently. Then again, who knows if there's big funds or banks, I guess you'd say deleveraging or whatever, unloading gold and silver to maintain the appearance that they're much healthier than they are, to keep money on the books, to pay off loans in other areas. A lot of banks made movements like that. They bought into gold and they wrote it up, and now they're selling some of it off to pay off some of those losses that were accrued during the heat of the financial crisis. One of the writers that I read just prior to the financial collapse of 2008, and I believe I read the article he wrote in 06 or 07. I'd have to look it up to find the exact article again. His name was Mike Whitney, and he wrote an article on the coming housing crisis. This is before anybody was talking about it, other than guys like Peter Schiff and so on. So he was one of the crazy people that foresaw this impending financial meltdown. And I read an article by him that really painted the picture of what was around the corner. And it struck a chord in me. He wrote an article it just came out today that I found it anyway. And it's called the Repo Implosion. And because of the default talk that's in the news right now, I wanted to just read part of this article for you and get your thoughts from it. You know, this is what we like to do here on the Junius Maltby channel. Read boring articles, talk about boring things with boring backdrops. So if you're bored already and you've checked out, sorry about that. For those of you who are still here and still part of the Junius Maltby channel and tuned in, I appreciate it. And there's probably 3 of you out there. So the 3 of us can have this conversation. You guys can leave comments. I'll go ahead and read the article. Here we go. President Barack Obama is determined to prevail in his battle with GOP congressional leaders on the debt ceiling issue, but not for the reasons stated in the media. Obama is less concerned with the prospect of higher interest rates and frustrated bondholders than he is with the big Wall Street banks who would be thrust back into crisis if there is no resolution before October 17th. Absent a debt ceiling deal, the repurchase market, known as repo, would undergo another deep freeze, as it did in 2008 when Lehman Brothers defaulted, triggering a run on the reserve primary fund, which had been exposed to Lehman's short-term debt. The frenzied sell-off sparked a widespread panic across global financial markets, pushing the system to the brink of collapse and forcing the Federal Reserve to backstop regulated and unregulated financial institutions with more than $11 trillion in loans and other obligations. The same tragedy will play out again if Congress fails to lift the ceiling and reinforce the present value of U.S. debt. Repo is at the heart of the shadow banking system, that opaque off-balance sheet underworld where maturity, transformation, and other risky banking activities take place beyond the watchful eye of government regulators. It is where banks exchange collateralized securities for short-term loans from investors, mainly large financial institutions. The banks use these loans to fund their other investments, boosting their leverage many times over to maximize their profits. The so-called congressional reforms, like Dodd-Frank, which were ratified after the crisis, have done nothing to change the basic structure of the market or to rein in excessive risk-taking by undercapitalized speculators. The system is as wobbly and crisis-prone as ever. As the debt ceiling fiasco suggests, the situation speaks to the impressive power of the bank cartel and their army of lawyers and lobbyists. They own Capitol Hill, the White House, and most of the judges in the country. The system remains the same, because that's the way they like it. U.S. Treasuries provide the bulk of collateral the banks use in acquiring their short-term funding. If the U.S. defaults on its debt, the value that collateral would fall precipitously, leaving much of the banking system either underwater or dangerously undercapitalized. The wholesale funding market would grind to a halt, and the interbank lending would slow to a crawl. The financial system would suffer its second major heart attack in less than a decade. This is from the American Banker, and he quotes the American Banker here. As banking policy analyst Karen Shaw Petro describes it, Treasury obligations are the water in the financial system's plumbing. They are the global reserve currency, and they are perceived to be the most secure thing you can own, said Petro, managing partner of Federal Financial Analytics. That is why it is pledged as collateral. The very biggest banks fear that a debt ceiling breach breaks the pipes. Rob Toomey, managing director and associate general counsel at the Securities Industry and Financial Markets Association, said institutions are concerned about whether Treasury bonds that default are no longer transferable between market participants. Essentially, Whatever the size is of the obligation that Treasury is unable to pay, that kind of liquidity would just disappear from the market for whatever time the payment is not made, Toomey said. By some estimates, the amount of liquidity that would be drained from the system immediately following a default would be roughly $600 billion, enough to require emergency action by either the Fed or the U.S. Treasury. Despite post-crisis legislation that forbids future bailouts, the government would surely ride to the rescue, committing taxpayer revenues once again to save Wall Street. Keep in mind, the U.S. government does not have to default on its debt to trigger a panic in the credit markets. Changing expectations can easily produce the same result. If the holders of U.S. Treasuries begin to doubt that the debt ceiling issue will be resolved, then they'll sell their bonds prematurely to avoid greater losses. That in turn will push up interest rates, which will strangle the recovery, slow growth, and throw a wrench in the repo market credit engine. We saw an example of how this works in late May when the Fed announced its decision to scale back its asset purchase. The fact that the Fed continued to buy the same amount of U.S. Treasuries and mortgage-backed securities didn't stem the sell-off. Long-term rates went up anyway. Why? Because expectations changed and the market reset prices. That same phenomenon could happen now. In fact, it is happening now. The Financial Times reported on Wednesday that Fidelity Investments, the largest manager of money market funds, had sold all of its holdings of U.S. Treasury bills due to mature towards the end of October as a precautionary measure, unquote. This is what happens when people start to doubt that U.S. Treasuries will be liquid cash equivalents in the future. They ditch them. And when they ditch them, rates go up and the economy slips into low gear. Note, China and Japan together hold more than $2.4 trillion in U.S. Treasuries, according to Bloomberg. Now the media has been trying to soft pedal the implications of the debt ceiling standoff by saying no one thinks that holders of U.S. Treasuries won't get repaid. While this is true, it's also irrelevant. The reason that U.S. Treasuries are the gold standard of financial assets is because they are considered risk-free and liquid. That is, if you have to wait to get your money, then the asset you purchase is not completely liquid, right? And if there is some doubt, however small, let's start that part again. And if there is some doubt, however small, that you will not be repaid in full, then the asset is not really risk-free, right? This is what the Fidelity flap is all about. It's about the erosion of confidence in U.S. debt. It's about that sliver of doubt that has entered the minds of investors and changed their behavior. This is a significant development because it means that people in positions of power are now questioning the stewardship of the present system. And that trend is going to intensify when the Fed begins to reduce its asset purchases later in the year. Because winding down QE will precipitate more capital flight, more currency volatility, and more emerging market runaway inflation. That's going to lead to more chin scratching, more grousing, and more resistance to U.S. stewardship of the system. None of this bodes well for Washington's imperial aspirations or for the world's reserve currency, both of which appear to be living on borrowed time. The media has done a poor job of explaining what's really at stake. While it's true that higher interest rates would make consumer loans more expensive and put the kibosh on the housing recovery, that's not what the media cares about. Not really. What they care about is the looming massacre in shadow banking, where U.S. Treasuries are used as collateral to secure short-term loans by the banks, so they can increase their leverage by many orders of magnitude. In other words, the banks are using U.S. Treasuries to borrow gobs of money from money markets and financial institutions, so they can finance their other dodgy investments, derivatives, contracts, and ancillary casino-type operations. If there's a default, the banks will have to come up with more capital for their scams that are leveraged at 40 or 50 to 1. This system-wide margin call would trigger a deflationary spiral that would domino through the entire system unless the Fed stepped in and once again provided a giant backstop in the form of a blank check support. Here's how Tim Fernholz sums it up over at Daily Finance. Many informed people are worried about a freeze in the tri-party repo market, akin to the cascade of troubles that followed the Lehman Brothers bankruptcy in 2008. In 2008, more than a third of that collateral was mortgage-backed securities. When Lehman went bankrupt, its lenders began a fire sale of the securities used as collateral, which drove down the value of other mortgage-backed securities, which led to more fire sales. This dynamic would eventually lead to a freeze in the repo markets, which at the time provided $2.6 trillion in funding to the banks each day. Today, most of the collateral in use is U.S. Treasuries and agency securities, mortgage-backed securities guaranteed by the U.S. government. If the ugly day of a default comes, lenders may simply stop accepting U.S. debt as collateral. That will have the effect of sucking some $600 billion in liquidity out of the banking system. Unable to get funding for Treasury securities, dealers would be pressured to sell them or other assets to find new funding, creating a fire sale dynamic. And of course, this scenario is only about how the treasuries work in the repo markets. U.S. debt is used as collateral for derivatives, swaps, and numerous other transactions. If they are suddenly worth less than expected, lenders can be expected to demand more collateral up front, putting even more pressure on the financial system. That's why pressure is building to raise the ceiling before the world's largest economy enters a scenario with so much uncertainty. Repeat, that's why pressure is building to raise the ceiling before the world's largest economy enters a scenario with so much uncertainty. So the Obama team isn't worried that Joe homeowner won't be able to refi his mortgage or that the economy might slip back into recession. They just don't want to see Wall Street take it in the shorts again. That's what this is all about, the banks. Because the banks are still up to their eyeballs in red ink. Because they still don't have enough capital to stay solvent if the wind shifts. Because all the Dodd-Frank reforms are pure, unalloyed BS that haven't fixed a bloody thing. Because the risks of another panic are as great as ever. Because the system is the same teetering, unregulated cesspit it was before. Because the banks are still financing their sketchy Ponzi operations with other people's money. Only now, the Fed's overbloated balance sheet is being used to prop up this broken, crooked system instead of the trillions of dollars that was extracted from credulous investors on subprime mortgages, liars' loans, and other equally fraudulent debt instruments. Can you see that? This is why the media is pushing so hard to end the debt ceiling standoff, to preserve this mountainous stink pile of larceny, greed, and corruption run by a criminal bank mafia and their political lackeys on Capitol Hill. That's what this is all about. Mike Whitney. Anyways, that's a pretty powerful, hard-hitting article. Wouldn't you agree? We are running out of time here, but I would encourage you to read his article that took place that he wrote at the beginning of the last implosion of debt. And just take into account that he called it fairly accurately then. So it's very likely and very possible, because he's a smart guy, that he's calling it right now. His words are, might be a little frightening for some to hear, but I do think there is a future of inflation coming and monetary madness. I think there is a change in the wind. As Professor Antal Faquette said, we're in a sea change. We're basically in uncharted waters economically. They can't say this is going to happen next year because we've been in this position before. Every day that ticks by, our economic ship is sailing further into completely uncharted territory towards a new world. And that new world could be not very good. So take into account what took place in the past, where we are currently, and remember that time ticks by kind of slow. You don't want to become complacent in how you're viewing things and just get used to the status quo. The price of things, there's no guarantees. We're not guaranteed that tomorrow will be a brighter day than the past and that our jobs will continue to pay what they pay, and that every day you go to the grocery store, a dozen eggs will be $3 and a gallon of milk will be $4. These things can change overnight. So keep an eye out, keep reading, keep communicating, discussing these things here on the channel with each other, and share your thoughts. And I appreciate you being here. If you stuck by for the duration of this video, my hat is off to you. I almost fell asleep reading that article. I'm not going to lie to you. I read this stuff and pay attention to it almost because I feel like it's incumbent upon me to do so for the preservation of my hard-earned money, my family, and the country I live in, my neighbors, and friends and family, etc. So appreciate it. Have a great day, and take care.